Got a lot going on this morning. So, Apple had a very high bar to hit yesterday, and I almost ran a short against it just because of the high bar. They kept talking yesterday on the different outlets about how they they couldn't have just a really good earnings. They had to have a flawless earnings, or they were going to dump. And when you think about the bar set to do such a thing, a flawless earnings. I thought, man, that's a pretty high bar to beat. Maybe I should try to put on some kind of lottery play and take it short. But I was already in Apple long, and you never want to go long short like that, trying to hedge your bets unless you're literally building an either or trade. And an either or trade really didn't fit the scenario. So I just stayed long. Apple managed to pull the rabbit out of the hat and have a flawless earnings. And the reason I'm bringing it up, it's not just Apple by itself with that earnings, right? It's the idea that a third of the companies in the S&P 500 have reported their fourth quarter results, and 78% of them have beaten analyst estimates for earnings. This is usually a galvanizing catalyst that rallies us up into a new quarter. And we started to see a little bit of that last night. And the reason that I started this week saying that there were four critical benchmarks is because Microsoft, Apple, the Fed announcement, those three alone were benchmarks that had to be hit, right? Apple, Microsoft, and the Fed announcement. And the last one was Tesla. And we managed to survive all of that. The Fed didn't come out as hawkish as we had thought. We had some negativity on Tesla, but not as extreme as it could have been. Microsoft did really good, but couldn't maintain it. Apple did really good and doesn't seem to be maintaining it. We didn't dump, right? If they'd have been bad, this market would have just crashed into new lows. It would have been a remake of Corona COVID February 2 years ago. And that's not what we got. But we didn't get that rally out either. We got a flattening yield curve, and we have a real lack of guidance. The market is still pricing in more rate hikes. Even after the Fed's announcements, they're pricing in more rate hikes. Now, whether they're right or wrong, whether they're getting more aggressive on the Fed, trying to anticipate that impact that the Fed is going to do before the Fed even does it, or that they're right and they're pricing in what we need, we'll only know until later on. But today's going to be one of those days where it's going to be a game changer. At 8:30 this morning, we get employment cost index and personal income and outlays. Both of those at 8:30. And these two are game changers. They're one of the preferred dots on the dot plot metric that the Fed uses. That's a mouthful. Don't try to say that three times fast. So it's a biggie. The consumer sentiment has been known to be impactful, but for a lot of times we just kind of shrug. Still, it's there. Don't sleep on it. It's 10 a.m. It's right around that time that we would normally be easing into the market. If you're like me, you don't wait, you don't trade the first 30. That may be something you want to go ahead and let pass by and then start dipping your toes in the water. And the rig count, I worked on drilling rigs for 20 years. Nobody out there cares how many rigs are drilling except those of us who were on those rigs, right? It's not expected to impact the market in any significant way. 8:30 and 10 o'clock. Yeah. Don't sleep on these two time frames. I'm telling you, it is significant today. You're talking about a complete and radical change in market sentiment. So a little bit of a plug. Always got to get some kind of commercial in here somewhere. I've been doing a lot of work on the Thinkorswim workbook. Now, this is one of my own little pet projects. It's not necessarily connected to the Bullish Bears itself, but That's why I share the link, because I make this stuff, and the Bullish Bears is my home. It's where I'm going to share the link to get to this material. Um, I don't make every single indicator that's in here. In fact, I would say I make maybe half of the indicators that are in here. But every indicator that I've ever come across, unless it's a paid indicator, in which case I have no right to be sharing it in a free and open Discord, you're going to find it in here. All kinds of things. Now, the Discord has a search feature in the upper right. So rather than reaching out to me asking what's in it, why don't you actually put in a little bit of effort, take a look around, and find the material that you want to find on your own, right? And then if you can't find it, if you've done a search and nothing comes up, then hey, yeah, reach out and ask me. I'm getting bombed all the time with somebody asking a very simple question like, "Where's that Yuval study? Did you even freaking look for the Yuval study, or are you just reaching out for me, hoping I'm going to take you by the hand and walk you over here and give it to you?" Right? So just do a little bit of work on your own. Take a look. Try to search for multiple things. If you don't find it in the first search, try a different search. If you didn't find it under Uval, maybe you would find it under Dvol. What is a Uval and Dvol? Well, that's a market internal indicator. Maybe it's under market internals. Peruse this site. You never know what you may find. Just kind of open up an area and take a look around. Who knows? You might see something you didn't even know you wanted until you seen it. And you decide, I like that. Now, in the group coaching courses next week, we're actually going to be talking about how to modify indicators to change, label colors or add a label or put a cloud in. Simple little coding that is a game changer for those of you who use Thinkorswim. Either way, the link to this Discord is in the Bullish Bears. So to get to it, just scroll down to the Traders Resource Zone, custom scripts. Just kind of scroll up a little bit. Right there, the Thinkorswim workbook. And of course, the Twitter packages, the alert system that I built that monitors Finance Juice, Live Squawk, Bloomberg, all kinds of market shaking information. And just, a cute little side piece of information that I found absolutely amazing. Twitter's faster than an earthquake. When they were doing research on Twitter, Northern California was hit with an earthquake, and it went out on Twitter. People in Southern California got the Twitter alerts and were able to hide and protect themselves before that earthquake traveled from Northern California to Southern California and hit those people. That's fast. You're looking for a fast bit of information on news that can move the market? Twitter. But if you're like me, you hate Twitter, you don't want it on your phone, that's a good way to go right there. These are free Discords. You don't need to pay to be in them. There is no chat in them. They're not places for us to hang out and chit chat and communicate with each other. So you now know where those links are, and I'm done with my shameless little commercial. All right. So we covered the economics for today. Keep in mind when it comes to the economics, it doesn't hurt to look around in a couple of different areas. One place is not always a really good way to validate the sources of what we have on the agenda today. I like to go to FX Street. It's free. You don't have to sign in, and you get an opportunity to get a little bit of an excerpt that they write on the dollar often. There are times where I've come over and there wasn't anything written on the dollar, but most of the time there is. And it's important to keep track of the dollar for a lot of reasons, but one thing that stands out is we need to know why it's moving. Just because the dollar is going up or down doesn't tell us enough. And right now, the dollar has been the thing that's been moving the market. Like when you see the S&P and the Nasdaq making extreme moves and you're looking around in the news saying, "What the heck just happened?" You're looking in the wrong spot. It wasn't in the news, it was in the dollar. So you kind of want to have an idea of what's going on the dollar, right? For today, we have broke beneath that critical level of 4,300. I mentioned yesterday in the main chat that I think it was on SPY where I made that. See if my target is still there. Yeah, 410 in SPY is the next target down. We could see another pause at that 420. It would give us a micro double bottom, but very likely we're going to see that 410 next. So I've mentioned multiple times before, no matter what it is that you're trading as a day trader or as a swing trader, you definitely want to come out and look at the daily. I've literally had day traders in futures tell me, "Well, I'm a day trader. I don't ever go out to those higher time frame charts." Well, if you never come out here, then you're guaranteed to never see anything, right? Maybe there's nothing to see. Maybe you come out and you take a look around and there's just nothing there and kind of shrug and whatever. At least you looked. If you don't look, you're never going to find anything. What are we looking to find? Well, there's major moving averages that markets respond to, right? And it doesn't really matter which one. You can kind of take your pick, the 100, the 200, the SMA, the EMA. Don't stress out over it. Just put on some moving averages. I promise you, it won't matter if it's the 200 EMA or the 200 SMA or the 50 SMA or the 50 EMA. Put on the 50, the 100, the 200. What you want to know is, are we about to hit one of these major moving averages? Because if we are about to hit one of them, the market's going to respond to it. You can print those on the intraday, on TrendSpider, even Thinkorswim. Just type in daily and you'll see a daily SMA indicator that literally allows you to print a higher time frame moving average. You can even, convert it over to something like a 1 hour moving average. But print your daily on there if you see that we're going to hit a, a moving average on our daily time frame. We're not at the moment, but it didn't hurt to look. So we do have this micro double bottom. It's not so micro now, but we're revisiting yesterday's level. And what often happens when a market revisits a pivot point is that it expands just a little bit further, right? So when price comes into a pivot, it's very likely going to expand a little bit more and a little bit more than the last time and a little bit more than the last time and then a little bit more than the last time until it finally makes an exaggerated move. That's what they do. So if you're a pivot point trader like me and you see price coming into a pivot point, don't just put your order right there on the dome, right at that previous pivot point, because it's very likely going to run you over, stop you out, make the move that you thought it was going to make, and you're not in it. So don't do that. If you look at the way this is a point of control indicator per bar, and those blue lines are the NASDAQ quarters. Look at how when we came down to that NASDAQ quarter, where the POC was at, where those point of controls were. Now, point of control is the highest amount of volume in that bar, right? Is the greatest amount of volume per bar. And look at how price responds at those quarters and where the greatest amount of volume is at. And those NASDAQ quarters are what we trade constantly. And if you were just to put your order on the dome, it would run you over and run away without you. So don't do that. We are outside of the volume profile. We are outside of the time. This is volume by time and volume by price. We're outside of both of those boxes. As you can see, there's a lot of danger overhead or a lot of restrictions to the upside. It will be a fight or a struggle to make it through these levels. It does get a little shallow. If we were to move that box up into the shallow area, gets a little shallow, and then we've got another volume node, a very strong area of resistance. It's not just some lines and some pivots, and we can say, oh, look, there's resistance right there. Yeah, we can confirm that with this volume here. And then we have a very large, shallow area that we're very likely going to be contending with next week if we don't dump below 4,200 today. It's a big if. We're already down 1%. We've got an ADR of over 2.25%, so we could very easily make that move. When we're talking about making the move, let's put some numbers behind it. By the end of today, we've got a $60 expected move with a $30 market maker move. That's a $92 expected move from this point in time right now to the end of the day. Now, how's that for numbers? And this is not some just random number, some cheap little indicator that somebody coded up. Billions of dollars are spent on using expected move every single day. There's a couple ways that you can make the statement that 70% of the time, price is going to stay inside that expected move. That's one way of saying it. 30% of the time, price is going to be outside of that expected move. That's another way of saying it. Either way, you now have your range. It's $90 higher or $90 lower than its current position in the market. I've even heard it said and or, because we can go 90 up and then flip over and go 90 down and then continue to go another 90 down. We're only at 1% right now, and that was a $45 move. So you can imagine that a $90 move would be two more percentage points. That'd be down 3% or up 1%, 2%. When we're outside of the volume profile, the expectation is that we're going to come back inside the volume profile. But notice right now we're moving farther away from it. We also broke a trend line. Now, markets move around quite a bit in the Globex. Um, and there are a lot of analysts who believe that this pre-market movement should not be held to high standards as we get into the intraday. I even know people that turn off their Globex charts. I've never really liked the idea of turning off volume or turning off any information and then just choosing to ignore it. But there are certain indicators that will react differently if you turn this off. So just make sure you understand what your consequences are if you do go in and turn off information in there. IBD suggests that a double bottom should go lower than the previous bottom. We're not quite there yet. Even if we were just to match the bodies and not the wicks, we're not candle closed. So we're wicking through it, but not closed yet. The way IBD describes it is that we should go lower than the previous low before coming back up if it's going to be a double bottom that bounces. And they said, not more than 10%, right? So something to consider. And when you're thinking 10% of what? Well, 10% of the range, 10% of the sweep, the move, you could use the quant tool, that quadrant lines tool. You could use something like that and just put that 10 in there. Be one way to do it. All right, so open it up, add a curve. We're on the one side, so it'd be 1.10. There's your 10%. So that'd be one way to do it. Should the market like the numbers that come out this morning, we're very likely going to see a re-challenge of these Globex highs. And then we will work on yesterday's open and yesterday's high. So all of our pivot points defined. The range is still intact. You can see where we've been all week is very clearly written out. And so far, it has been perfect. Yesterday's reversal, right where we would expect it to be, right at the top of the range. So the range is 100% intact. Well, if we maintain that, then we're going to be looking for a reversal this morning to work our way back up through the range again. Or the NASDAQ. Also a double bottom. Could be argued that we're looking at a triple bottom or even a fourth bottom. But I want to focus on yesterday's low. It's an institutional pivot point. And just like before, we're going to look to expand beyond that, at least 10% if this is a valid double bottom, and we're going to return or reverse or reciprocate at that level. Then we would be looking for that additional 10%. This is another one of those critical levels that we broke. If you were to go out to the higher time frame and take a look around, you can see that we are negative and getting worse. Morgan Stanley has the sevens law. If you think about it from that point of view, if 7% is a pullback and 14% is a correction and 21% is a bear market, well, we're farther than a correction, but not quite in bear market territory. Now, Morgan Stanley's numbers doesn't match everybody else's number. And I believe that Investors Business Daily uses uh, 10, or maybe it's Investopedia that uses 10. Either way, you want to like pick one analyst style or one technical analysis style and use that one, right? And that way you can just stay consistent in whichever way you want to read it. Either way, the NASDAQ is down 18.5%, or very close to that, 18.25% from its highs. We are still inside this one candle, and that right now is the volume node candle. That's your controller candle. So a break through this to the downside is going to get really critical. Your targets on such a break, you can use the quadrant lines for that as well. When you make measurements like we just did, 50% is a good place for getting most of your risk out. And that puts us at around 13,250, and then 12,750 is your 100% move. Notice when we line that up, it fits with other price metrics to the left. It's how you can validate your drawing and make sure that you're putting it in the right spot. Does it line up with something else? So should the market like this news and we begin making our way back up in the other direction, we're going to challenge our own Globex high. We'll deal with yesterday's open, and then we'll deal with the highest point of yesterday. We do have that 200 moving average to contend with, and it has been a beautiful reset on each new leg lower. So just seeing us break and close above that would be a game changer. It'd be significant. Now, I talked about the dollar moving us around. You see that confirmation in the VIX. You see the moves that we had yesterday in the bonds, and it was the bonds that started out making the moves yesterday. This was part of the move that we were seeing. Stocks and bonds were both making the move in the same direction, and the dollar really wasn't doing much at first. Then we started getting these exaggerated pushes, and it doesn't look like it went very far, but those were just shaking the market up. So you really want to keep your eye on the dollar and the bonds. This rally between these two markets, although it doesn't look like they went very far, the volume and the volatility right now is making these charts movements appear minor, but these are massive moves. If you were to look at them in a market that wasn't so violent, you would see a bond move almost 1 point in a 15-minute candle. It's extreme. Massive amounts of money and massive amounts of impact in our marketplace. So they don't look very big, but these two are what's rocking the market. So you definitely want to keep your eye on them when they start making exaggerated moves. When we come down into a support level and then it breaks that support, look at where we're at in the indexes. We want to see it at resistance breaking to the upside as the bonds are at support breaking to the downside. We want to see them inverted, like a teeter totter, that one side goes up and the other side goes down. It doesn't always work that way. And multiple times this week, we've seen the bonds and stocks move in the same direction at the same time, right? And even though it's not supposed to work that way, that's what's happening. So, we just got to take it with the way it is. Tastyworks did a lot of research on how stocks and bonds will often correlate throughout history. We're in this very odd market situation right now. One of the biggest arguments that I've been hearing is that the market has no guidance on what the Fed is about to do, because what they're about to do, they've never done before, right? They're going to try to apply multiple tools at the same time. It's never been done. They don't know the outcome of it. It's all just a big experiment. I know nobody really wants to hear that, but they don't have any idea what's going to happen. They're just going to push some buttons and turn some knobs and see what happens. The market doesn't really like that. So keep your eye on the bonds. I use the 30-year, but looking at the 2, the 10, the 30, there's even a 13 ETF bond that you can look at. Just kind of keep your eye on things. The same thing with the VIX. There's a lot of different VIX products out there. I tend to use the VIX and the VIX futures. If you are using the VIX, there's a VIX 9-day. There's a 1 month, a 3 month. There's a lot of different VIX products out there. Keep your eye on the backwardation levels. You can see that the February is way higher than October, September, August, July, June. We don't normally go that far out when we're looking at the backwardation curve. If you were to turn off some of those farther dated curves, you would still see the backwardation. We want to see contango. That would be February cheaper than June, right? Because things that are close in should be cheaper than things that are far away, because there's so many things that could happen in the future that we just can't really price that in. Markets generally are more worried about the future because you could have earthquakes, tornadoes, flood, war. Right now, the market is way more concerned about their immediate market environment than they are things farther in the back, which makes our trades in the options market a little off, because we're getting that front month volatility and we're getting less back month volatility. But for calendars, this is really good. So you can go out in something like Apple and buy a call, 100 days out with some low volatility, and then sell calls against it in this higher volatility. Yesterday, I sold a call on SPY thinking, well, I'll close it at around 40% in a week or two. I hit 40% in an hour. Nice. And the long call that I was holding, which was farther out in time, it was losing because SPY was going down when I had a long call, but it lost less than what I made in the short call in an hour. So you can basically just buy calls right now really cheap and sell calls right now really expensive. If the long call loses, screw it. Okay, you lost there, but you'll be able to make your money back on the short side of that plus some. It doesn't even need a hedge because you're building the hedge. The short one is your hedge. If you're trading in the futures and you're finding it very violent right now, and we know that we need a greater size stop in a violent market, use options to give you a little bit of a cushion or a pad so that you can trade futures with a wider stop and not feel so uncomfortable about it. Generally speaking, when I do that, I'll sell to go in the same direction that I'm about to buy a futures contract. So if I want to go up, I'd sell a call up here, and then I'd buy a futures contract to make an upward move. If I'm wrong and the market goes down, my futures contract is losing, but that short call that I sold is buffering some of that loss. Now, a short call or a short put is only going to make you the money that you sold it for. You don't get more than that, right? When you sell someone, they don't come back later and say, this car was so great, I want to give you more money for it. Well, it's the same thing with a call or a put. What you sell it for, that's what you're going to get out of it. But at least you'll have an understanding of the kind of buffer that you can apply. Now, if you wanted to double down in the move that you're doing and you go long off of these lows buying a futures contract, you could also buy a call down there, or you could sell a put down there. That would be doubling down in the trade that you're in if you feel that confident about it. And generally speaking, when we make these very large extreme sweeps to the downside, that's generally where we're selling puts. And when we have these big impulse moves, that's generally where we're selling calls. Just flip things over and use them to your advantage. Nobody is scheduled to stream today at the Bullish Bears in any of the channels. Although I'm not scheduled to stream, I very likely will be streaming in the large caps, and we will be talking about futures and at least SPY and the NASDAQ. So if you're a futures trader and you want to just come hang out in the large caps where we talk stocks, options, futures, we talk about it all because I'm the one streaming and I trade everything. Then I'd love to see you guys come in and chat, hang out, you know, throw poo, do something. I'd love to see you guys there. Right. So you got the invite. Looking at the sectors, my benchmark on seeing the sectors up or down in the pre-market is at least a 0.5%. And you can see right now that natural gas, which by the way is getting squeezed like crazy, natural gas has got a nice pop going on. It's got that very beautiful failed flag with a Busby play. And remember, it only owes you back to the top, by the way, in that Busby move. And it's about there. I don't really get much into the double, triple leveraged products, but FAS is up 4%. Bitcoin is up 2%. The oil is up quite a bit. There's been a lot going on the oil side. And, they do have the rig count today, but generally speaking, that rig count, I've never seen a rig count print shake the market. I'm not going to say it can't happen because we know the market can do whatever the heck it wants. But yet, I've ever seen the rig count rock the market. The devil's metal, silver, just basically flat. I'm always interested in what's going on in EEM, this emerging markets. This is how I gauge global risk and participation. Well, it's down nearly 1%. So we're we are risk off around the world. They're not looking to get frisky this morning. We broke that critical low. I don't really come in here and try to perform analysis on EEM. I almost exclusively look at this thing on a day-to-day basis, right? What are we doing this morning? What did we do yesterday? What are we doing tomorrow? That kind of thing. It'd be like using this as a fuel gauge for your car. We don't analyze the fuel gauge. You just look at where the gauge is, right? We're down this morning. The worst ones are energy. It's a little bit of a surprise. Look for a red to green to show up today. Small cap still isn't working out yet. We finally broke that massive critical range, but it's not done. It's not done by a long shot. And there's been a lot of analysts talking about 155, 160 area in the small caps. Oh boy. So the takeaway is today we're looking at economic events. We're looking for some real violence to come in this morning. But there is always the third option that absolutely nothing happens. And the reason that that has to be on the table is because while I talked about going up and I talked about going down, there are times where the data comes out and they don't know what to do with it. Maybe it's unclear or it's data that they just weren't expecting. And then they got to call the nerds and they got to wait on the nerds to crunch the numbers and come back and give them some guidance on what they want to do with those information. So keep in mind that the third option is on the table, that we do nothing more than just sit tight through most of the morning. But that afternoon, he's going to get pretty violent out there. This is the last. Nope, we got one more day. I was about to say this is the last day of the month, but we have one more. Monday will be the last day of the month. So we got quite a few crypto names that are up this morning with that crypto ETF, BITO. We also want to go in and look at the electric vehicles market. This is our own way of building our sectors, since there is not an S&P sector like a legacy sector, the way that we have, energy and industrials and production. So nothing really standing out in there. We look at the pot stocks. Again, kind of a mixed bag. Pull the stems out. Now, we've been using these two watch lists down at the bottom, weekly options 1 and weekly options 2. And the reason that there are two watch lists is because TrendSpider won't let me make a watch list with 600 names in it. So I had to break that 600 names into two different groups. I didn't really put any effort into, who was in one group and who was in the other group. I didn't bother. These 600 names are companies and ETFs that have weekly options. That was the only criteria. Well, as you can see, it's a long list, and there are plenty of things that are moving around this morning. But when you try to apply a list like this in Thinkorswim, you're just going to get a bunch of errors in your watch list column because it's going to say, hey, there's too many names in there. So what we did is we went to the CBOE website and we downloaded December's most actively traded companies. And we tried to keep that list near or around 100 names. And then we removed almost all of the ETFs and ETNs out of it. So it's a much smaller list, and it doesn't give you an error when you put it in your Thinkorswim watch list column. And then it makes it a really good searchable watch list too. And yeah, as you can see, there are a lot of names up this morning. I mean, Visa had amazing earnings, so yeah, it's up in the pre-market as well. But you start getting into some of those energy names and steel, shipping. I mean, it is kind of flat at the moment, but we could look for some red to green. Some of those IPO names are up this morning. Now, remember, when you're looking at the list, it's not just one single name that you want to focus on. It's what does that name represent? Who are the peers in that group? Try to keep your watch list as small as possible as you come into the open, right? Because you don't really want to be trying to watch 5 or 10 names. You want to narrow it down to 1 or 2 really good names. Find something on their daily chart that adds more uh, conviction to putting that name on the list. Maybe it's a red to green or a trend line breakover or IX10 inside day breakout, something more than just, well, it was up in the pre market. All right, everybody, that's the morning briefing. I will see you all in the large caps. Going to start probably a few minutes early, uh, around 9:10 or so. I'll see you all there. So I was getting ready to kill the stream when I seen some questions in the chat. Generally, I don't focus too much on the chat. These morning briefings are designed to be in and out hard hitters really quick and really fast. And if I spend too much time going through the chat, then they end up with these really long, drawn out morning briefings. So I didn't catch the chat at the time. There was questions about how do you come into the Discord and how do you join the chat. If you come over to the Bullish Bears and sign up, you can sign up for a free trial. You could sign up for on a month-to-month basis. Let's see if we can do this without me being signed in again. I want to show you what it looks like if you weren't signed in and you were just to come out to the Bullish Bears. So it's going to the bullishbears.com and not logging in. Of course, you wouldn't be logged in yet. I believe they're still running a trial where you can come in for like 7 days or 14 days without commitment, that you can just come in and take a look around. I gotta say though, I mean, the chat rooms are awesome because we got pennies, large caps, futures. That's okay. I like having the chat, but it's the education side that I've put most of my time and effort into. I developed these next level libraries on options and futures trading. That's the heart and gold for me. It's where I've spent most of my effort, because options trading is where a lot of people struggle. They just think it's really complicated. Well, I mean, it can be complicated, but all we got to do is adjust that language barrier, put things in the normal people language instead of that bank language, and it becomes so much more easier to grasp and learn from. And then, of course, with futures, I'm a pivot point trader. It's a little different than maybe a lot of other people trade futures. And that next level, that's the ticket. But either way, come on in, give a shout out to Signet, and I'll see y'all at the live stream this morning.